Hello, and welcome to this episode of the Capital Stewards Podcast. As we usually do in the fall, today we're going to focus on alternative investments. You may have a lot of questions about alternatives. What exactly are they? Should you have them in your portfolio? Do they provide a lot of return? Do they help diversify? Should you put them in your 401k? That's been in the news a lot lately. So, in this episode, we're going to cover all things alternative investments as we start off in November of 2025. So, let's dive in. So I want to start first with the purpose of alternative investments. I personally am not even actually sure what alternative investments really are. What is alternative versus what's a regular investment, and how are they different? Instead of branding things sort of as like alternative and traditional, I think a better approach is to actually think about things the way that we think about all of our portfolio construction at Capital Stewards, which is we have equity investments that are designed to drive growth in portfolios. We have diversification and income investments that are designed to diversify, provide risk management, provide income. And then there are some things that kind of sit in the middle of those two things. And so what I like to do is take all of the alternative investment universe and bucket it kind of into those categories, right? And so when we think about growth investing or investing for growth, that's venture capital or the buyout side of private equity funds. Those types of funds are going to provide long-term growth. Historically, that's been above the public stock markets. We're going to talk more about that in a minute. The returns, though, come at the end of what's called the J curve. So the first couple of years you own a private fund, the returns are actually negative. They're taking your money and investing it in the companies, and then the returns come when they ultimately sell them seven to hopefully 7 to 8 years later, but sometimes as long as 10 years later. And the other thing that's really important to understand when you're investing, particularly in the venture space, is I think a lot of folks sort of misunderstand how that world works. And, hey, these guys find all of these great companies. Well, they do find a lot of the great companies, but the way that it really works is they invest in, say, 10 companies, and then in those 10 companies, there's one really big winner that ultimately becomes maybe public, and you hear about it in the news, becomes a unicorn. A few others break even, and the rest are actually losers. They lose all of their investment. So the venture business is really about finding a few really big winners that are going to drive growth in that part of a portfolio. So that's kind of the equity side of the alternative universe. Then there's kind of some things that are in the fuzzy middle. But I like to think about that as private debt and certain types of real estate. And in these assets, returns generally are paid as income, right? It's about the income and the distributions that are coming out the fund, not so much the capital appreciation. Generally speaking, you're going to produce income that's above the traditional, bond income. So traditional corporate bonds or treasuries, things like that. And then in real estate, there's obviously lots of different ways you can invest in real estate. But here, what we're really talking about is sort of core real estate, right? High quality properties, lots of tenants. The property is producing cash flow every month, every quarter. So obviously, if you get more opportunistic and you start into real estate development or buying properties that need to be, remodeled or retrofitted, then obviously that's less of an income asset and probably more towards the growth side of the portfolio. And then the last bucket of assets in the sort of alternative space, I think of our diversification and income assets. And we buy them because they're uncorrelated to our equity assets in our portfolio. We buy them because they help lower the risk to investors if we go through a period of economic turmoil or recession or whatever else. These are assets that should still provide returns and help our overall portfolios from hang in through those challenging periods. You think about this as things like commodities, right? Physical assets, gold, oil, orange juice futures. There's all kinds of commodities in the world, metals. And then you've got the world of hedge funds. But I think when we talk about hedge funds, and we'll spend some more time on this too in this episode, a lot of folks think hedge funds are sort of like these funds where there's masters of the universe and they sit there and they make these investments and they make, just these extraordinarily high returns. That's not really the way the hedge fund universe works today. It's not the Wild West of investing. Hedge fund investing really today is about following specific strategies that produce generally sort of low single-digit returns consistently over a period of time. That's what a lot of you've heard the so-called quant trading shops and other folks. That's what they're doing. It's return consistency is really the goal. It's not sort of like shoot the lights out type of returns you may have been familiar with from like the 1990s and 2000s. So one of the major selling points often in alternative investing is diversification. So what does that mean? Right? Diversification is simply going back to this concept of portfolio correlation. And what that means is do all of the assets that are in your portfolio move up and down together So when one's going up, do they all go up? And then conversely, when one is going down, do they all go down? Or are some of those assets moving in opposite directions? That means when one goes up, the other one goes down, and when one goes down, the other one goes up, right? And diversification is the idea that not everything in our portfolio goes up or down at the same time, particularly down, right? That's really in investing. What we care about is what's happening in those troubling times. And we want to put assets in our portfolio that are going to go up when maybe the stock market or the economy are not doing as well. So, and why does that matter to you as an investor? Generally, the reason it matters is because it's going to help you stick with your portfolio, right? If we were all completely logical and we didn't have any behavioral biases and we never got afraid of what was going to happen in the market, and we never ever sold any of our investments because things didn't look that great when we looked out our sort of proverbial window at the economy, then we would just buy venture capital and we would hold it for 40 years and our portfolio returns would be really, really high. The problem is that means that every few years your portfolio gets cut in half, right? When we go through these down cycles, and most folks don't really like that, right? You want a smoother ride. You want to drive returns, but you also want some consistency in your portfolio returns. And so that's why we seek portfolio diversification. So diversification is a good thing. It's something that you should seek out. And alternatives tend to show sort of low correlations to traditional asset classes. You can see on the chart that the red areas have strong positive correlation. That means they all move up together. And the white or green asset classes move either, more zero correlation, so they don't have correlation to the stock market, or they have strong negative correlation to the stock market. And the alt universe tends to be at the bottom of this chart here. They have more negative correlation. So they have theoretically, and we're going to talk about this in a minute, they're good diversifiers. That means that they can help provide portfolio diversification. And when we run that through traditional portfolio math, you can see in this chart, again, it's a little bit of an eye chart, but I'll talk you through it. If you look at the chart on the right-hand side of the page, you can see that the purple line in the middle there, and you can see that's a portfolio that has about a little bit more than an 8% expected return every year, but it's got some volatility. It's about, the standard deviation is about 12%, right? So you're going to see returns that, maybe go up to the 20% range or maybe even go negative, right, with that kind of portfolio over time. If you add alternatives to that portfolio, you get that big green arrow and it shifts from the purple dot to the orange dot. So what you see happening is that the expected return, it goes up a smidge, right? What alternatives tend to do today more than drive significant returns is they tend to move, they tend to reduce the standard deviation of portfolios or that volatility. So what happens is you can get the same amount of return, maybe slightly more return, but with a lot less volatility. That means your portfolio really is going to move around, maybe 4.5 or 5% from a standard deviation perspective. So maybe your returns are something that's closer to, like, say, 3 or 4% in a really bad year, or maybe 15% in a really good year. So what happens is that variance in portfolio return shrinks down, and that's really what alternatives do. The problem is all of that is based on hypothetical statistics. And so if you just read that, you say, well, hey, Brian, if I can have, the same return or maybe a little bit more return with less risk or less volatility, let's do that. Let's put a bunch of alternatives in my portfolio. Well, there's a couple of challenges with that approach. And this is how alternatives are generally sold, right? It's, hey, they're diversifying assets, and so you should put them in your portfolio. Well, I like to think about this as sort of the challenge of statistics versus real life. What do we know about, just conceptually, about the way that returns and risk work, right? As return goes up, risk goes up. So that means that in order for us to have an asset that's kind of in the top right box of this chart that's got a lot of expected return, it should also have some risk associated with it, right? Otherwise, you wouldn't be generating any returns. Why would someone pay you a return if you're not actually taking any risk, right? You're generally giving someone capital, they're investing it, and there's a chance that you might not get it back, and that's why they have to pay you back a lot more than you gave them to start with, right? That's how returns and risk work. So we know that that's kind of how traditional growth assets work. If you were to look at like private equity, it would actually be in this top left box, which is a high expected return with a lot lower standard deviation, which is what makes it look like a really good diversifying asset. So I put this in the box of things that don't exist in real life. And we're going to talk in a minute about why they don't actually exist in real life. But, private equity returns are actually really high, but what we're going to talk about is that the standard deviation that you see a lot of times is not actually right. So it means that the risk is really actually closer to the top right box here, or the traditional growth assets that are in your portfolio. And then in the bottom, right, you've got traditional diversification assets. That's your bonds, your treasuries, corporate debt, cash, all those kinds of things. And so those things have lower risk and they have lower expected return. And then in the bottom right box, you have things like commodities where we have, higher volatility and lower return. And what I like to say about these assets is you should use them sparingly. Why? Because they have a lot of risk and they don't traditionally provide a lot of return. So why would we put things in a portfolio that have lots of risk and don't have a lot of return, right? So what alternatives do is they live in this kind of middle axis, right, or this kind of reverse diagonal axis that either don't exist in real life, or we should use them sparingly when we look at the way that sort of reality intersects with statistical investment data. So let's talk about why a lot of private equity funds and venture capital funds are sort of these unicorns that don't exist in real life. So a couple of things. One, in the stock market and in the publicly traded bond market, valuations are reported every single day, right? The price goes up, the price goes down. In the private market, that's not the case. Valuations are only reported generally quarterly. There's no daily volatility. And so that makes the volatility or the risk of private market investments, particularly private equity and private debt, look a lot less risky than their public market counterparts. Does reporting a valuation change the underlying risk of the investment? No, it doesn't, right? If you're buying the equity of a company, you have equity risk, you have stock risk. If you're buying the debt of a company, you have debt risk. Whether you find out what the valuation is today and tomorrow, or only at the end of the month, isn't really material to the actual amount of risk that you're taking. There's also issues potentially with some of those valuations, right? Those valuations are calculated either by the manager that you're paying to invest with, or someone that they pay to do it, right? So they have some incentive to be, we'll just say optimistic about how they mark those assets in your portfolio. We talked a little bit about this earlier, but the returns are not spread evenly over time. There's this J-curve effect, right? You generally pay capital down at the beginning of an alternative investment. You're putting money to work in these companies. And then over time, those returns come back until all the returns come at the end. So that has implications for what the sort of some of those diversification statistics look like as well. And then lastly, I would argue that volatility is a poor measure of risk, again, because assets can appreciate, materially between reporting periods. Just because something has a low or a high standard deviation, which is how we in the investment world manage risk, doesn't mean that it is not risky or risky, right? We don't have a good statistical framework to use to measure risk. What we can do is use some statistical techniques to say, hey, what if we remove some of these challenges with the reporting for things like private equity and private debt? What would those look like if we made them sort of like public market assets? And I'll skip all the stuff on autocorrelations here. I gave this presentation to a group of professional investors a couple of months ago. So I'll skip the statistics, but what that really means, if you look at the chart that's on the right-hand side, you can see that private equity buyout funds, that 0.86 means that, you can think about that as they kind of move 86% of the way with the stock market. So that means when the market goes up 1%, your PE buyout fund is going to go up 0.86%, right? And when it goes down, it's going to go, so it's going to go up a little bit less when the market goes up, and it's going to go down a little bit less, but that correlation there is pretty high, right? Venture capital, right, moves more than the market. So when the market goes up 1%, your venture capital fund's going to go up a lot more than the market. And conversely, when the market goes down, your venture capital fund's going to go down a lot more than the market. Private debt actually has a better sort of adjusted beta. So you're actually getting some good diversification. And that makes sense because after all, you're buying a bond, you're buying a debt instrument, not an equity investment, not an equity instrument. So private debt does have some pretty good diversification benefit compared to the stock market. And then you see real estate there also actually pretty close to the S&P 500 when we think about market betas. So what does all of that mean, right? I think the best way to think about alternatives, again, is in those two buckets. They're either part of the equity growth part of your portfolio, they're part of the diversification and income part of your portfolio, but simply assuming that because something is alternative, it lowers the portfolio risk or it makes your portfolio more well diversified, just because it's alternative is a fallacy, right? And that's so often how alternatives are sold. That doesn't mean they're not useful in portfolios, and we're going to talk about some of the reasons why they are useful. So this is not a don't ever buy alternatives presentation, but it is really important that you use alternatives with your sort of eyes wide open to what reality is. And some of the techniques that are used to sell alts are not necessarily true sort of in real life when we sort of abstract from sort of the vagaries of some of the data that's out there. So the next thing that's really, really important when we think about alternatives is that manager selection just means more. So it's football season here in the Southeast in Huntsville, and we talk about the SEC, we say it just means more, right? Well, when you think about buying a mutual fund or an ETF, you're probably going to get performance that's pretty close to the overall the benchmark, or pretty close to how other assets in that asset class perform. There's not that much dispersion, right? If you go buy the Fidelity large cap growth stock fund, it's probably going to perform pretty similar to the Vanguard large cap growth stock fund. It's probably going to be pretty similar to the Capital Growth large cap stock fund, right? Growth stock funds performance. All those things tend to correlate together. There's some reasons why that happens. I won't cover that here, but generally speaking, which manager you choose in public markets is going to matter, but it's not going to matter a ton for most assets. In the private markets, that is not the case. You can see on the chart, outperforming the benchmarks is all about whether you choose the right manager. If you don't choose the right manager, you may as well not have invested in private assets at all. If you think about just the private equity space, which has the most dispersion on the left-hand side of this chart, those, your best managers, absolutely, they've outperformed public equity markets. They're generating 20+% IRRs, really good performance. The problem is if you pick a manager that is simply average, now your returns actually look kind of just like the public market, right? So the bottom half of the managers are not outperforming public equity markets. And if you pick a manager that's in the bottom quartile, you're significantly underperforming public markets. So the return dispersion matters, and you've got to be able to not just decide, hey, I want to invest in, private equity and I have this fund that's available to me to invest, so I'm going to invest in it. You've got to make sure that you're investing with a manager that is going to be ultimately be successful. And a lot of times the managers that are out there that are super successful are not in need of new capital. So a lot of times the opportunities that we have to invest in private markets are with subpar managers, and that creates obviously some issues. The other thing to think about in alternatives before we dive into some particular asset classes is that not all alternatives are liquid. We talked about commodities a little bit at the beginning. You can buy oil, gold, precious metals, all kinds of commodities related to food, things like that on the public markets every day. You can even buy them in an ETF, right? So you don't even have to get into the futures market or options or anything complicated like that. You can buy an ETF that has exposure to all of these things. And what you can see on the chart here, if we look at commodities on the left-hand side, you can see sort of what the returns have been over the past few years. The thing that I will caution you, this again goes back to kind of the manager selection, but if you look at that green line and the blue line, those are commodities funds, right? And they've done particularly well, or not particularly well, but they've had positive performance over the last decade or so. If you look at the red line, which is also a commodity fund, but it just uses a slightly different approach to the way that it invests in commodities futures, it has negative performance, right? So the particular fund that you use matters a whole lot. And then on the bottom of that chart, you can see the correlations. Again, we talked about that at the beginning. You see 0.4 there and 0.18. So you do see in the commodities world some good diversification benefits relative to bonds and relative to stocks. And the metals you see on the right-hand side, again, gold has obviously done really well over the last few years. So has silver, and those have lower correlations as well. And so you can get some of that diversification benefit without locking up your money in 7 to 10 year, private equity or private debt vehicles, throwing away the key and never being able to touch it again. You can use precious metals, you can use commodities and other assets to invest in things that are not stocks and bonds. You just need to be thoughtful and careful how you do it, because you can lose money in any kind of investment. But here, if you're investing in a space that you don't have a lot of experience in, you could end up in a world of hurt. So let's shift gears a little bit now that we've talked kind of high level about the alternative space, and dive into some of these asset classes. More specifically, we'll start with private equity. We'll talk about private debt, talk about hedge funds a little bit as well at the end. So I titled this kind of page, "Will Private Equity Investments Change Your Life?" A lot of folks are like, everyone's investing in private equity. I must invest in private equity. This must be really, really great, right? Well, when we look at return information over the past decade or so, venture capital has actually underperformed the S&P 500. Venture capital funds as a group, again, you're talking about the median performance, right, is 11.6% a year. The S&P 500 has been closer to 13% a year, 12.87%. So venture capital, good performance, right? But not better than the S&P 500. And then the growth buyout space has outperformed the S&P 500 by a couple of percentage points over that time period. So if you think about it from a return perspective, have buyout returns, have growth private equity, funds done well? Absolutely, they've done well. But the outperformance there is a couple of percentage points on an annualized basis. It's not like, your portfolio is performing, 5 or 6%. And then if you go buy the private investments, all of a sudden now you've got these 20, 30, 40% returns. That's not generally speaking the case. There's also, there's Stephen Kaplan from the Booth School of Business has done some good research on private equity funds. And generally speaking, and this is some of his charts here. So this question of like, does the private equity market outperform the S&P 500? And generally speaking, it does by about 5 percentage points a year. So is private equity potentially a good investment? Yeah, it is potentially a good investment. But again, we can go back to, is it going to change your life? The answer to that is no. So could private equity be a part of your equity portfolio? Absolutely. But if you're sitting there saying, well, I don't have any private investments in my portfolio, am I somehow missing out on this great opportunity? I don't think that that's really the case. Where I do think private equity is more useful is, we really over the last decade have seen small and mid-cap publicly traded equities really underperform. And I think a lot of that is due to the increase in activity we've seen in private markets over the last decade. And so if you think about, maybe complementing a public equity portfolio of large cap stocks with maybe a private equity portfolio of smaller companies, I think there's some opportunity there to be thoughtful about how you use private equity in your portfolio. So again, private equity, good returns, right? Absolutely have provided good returns. Diversification benefit, not so much, because again, you're buying an equity. So if you adjust that, you're basically just getting movements that are in line with the S&P 500, but good outperformance over the S&P 500 over time. Let's talk about private debt. This market has obviously grown dramatically over the last 10 years. Everyone has been very interested in what is happening in the private debt market. You can see on the chart kind of on the upper right hand side of the page, you can see the private credit market, starting really, really small, 07, 08, and then you see just this significant growth coming really in the back half of the 20 teens, 17, 18, 19, 20, and then all the way to now. And then you see some estimates for what the market will look like over time. So private debt returns as an asset class, the median returns have been about 8.5%, 8.46%. So that's pretty good, slightly above, not significantly above, but slightly above investment grade bonds and slightly above publicly traded high yield bonds as well. So the closest, when we think about private debt, the publicly traded high yield market or junk bond market is sort of the closest proxy to what's in a private debt fund. And so these things have done a little bit better than those two markets. So there is some return benefit there. There's also some diversification benefit. We talked about this earlier. Private debt in particular tends to be obviously less correlated to the stock market. It's a debt instrument. It's a bond at the end of the day. So some opportunity there. A lot of that growth in private debt, though, has been generated by, it's not that we've created a new way to do finance. It's just that after the financial crisis, banks really had to pull back. There was new regulation, right? And the large banks, particularly the investment banks, were forced to pull back from that publicly traded junk bond market or the high yield market. And so private credit funds sort of stepped in to fill that gap. So that really is what is driving the private credit market today. It's not really a new form of financing. It's just shifting it from bank balance sheets onto the balance sheet of us as investors. And that can be good. It can come with some good benefits. So one of the things that we've seen over the last couple of years is that, so our last asset class category here are hedge funds. And I think the question that comes up a lot is, hey, aren't there hedge funds out there that generate just massive returns? We heard about these people in the late 90s and early 2000s. What is a hedge fund? What are they doing, and how can they help my portfolio? So I think it's important to kind of just take a step back and go back to what is the purpose of a hedge fund. The purpose of a hedge fund, generally speaking, is to be hedged. And what that means is they invest both long, so they buy, say, a stock, but then they also short another stock, right? So their goal is to make money regardless of the direction of the market. So if the overall stock market goes up, that's going to be good for the long side of their portfolio, but it's going to be bad for those stocks that they've shorted. What they're really trying to do is say, hey, we think this particular asset or this particular stock is going to go up, and this particular stock, the other particular stock, is going to go down. And so they construct those portfolios in a way that they're less correlated with markets. And what that does is it generally, over at least over the last decade or so, has led to hedge fund returns that are, call them low single digit type returns, but they're very, very consistent over time. So that can be really helpful in a portfolio, particularly if you have a lot of volatility in other spaces. A couple of the categories, right? Multi-strategy hedge funds, you hear about those a lot today, Millennium, right? Some of the big funds that are out there. They have lots of different hedge funds, and what they do is they allocate among different hedge fund strategies within their particular firm. Absolute return funds, right? Goal there, again, produce mid-single digit returns every single year, year after year, regardless of the market activity. Long, short, or market neutral funds, again, they're long and they're short, they're hedged. They're trying to provide stability of return that's uncorrelated with the market. And then quant trading funds, these are funds that are providing liquidity to the market. So they're buying stocks and selling stocks. They're literally taking advantage of sort of second by second mispricings that are happening in the market and doing that with leverage. All of these types of funds, they're engaged in arbitrage. So what they're looking for is mispricing in the market and asymmetric risk sort of return trade-offs where they can make money by buying something and shorting something similar, right? They're not sort of, hey, let's just shoot the lights out, borrow a bunch of money, go buy some stocks and hope we win. That's not what the hedge fund market is today. One of the big challenges is as we have gotten better at investing, as data has become more ubiquitous across investment markets, a lot of those sort of arbitrage opportunities or those mispricings that have been in the market, a lot of those opportunities have declined as more and more hedge funds were created. They sort of started, to sort of compete away, if you will, some of the return opportunities. And so, there's kind of some unique challenges in the hedge fund space because we see declining alphas. We see the excess return that hedge funds are generating going down over time, and it's also difficult to predict which ones are going to do well. Last year's performance in the hedge fund space is not necessarily indicative of next year's performance in the hedge fund space. So which fund you're going to predict, you've got to find the hedge funds that you're going to stick with over long periods of time to try to be successful investing with hedge funds. So the right way to think about hedge funds is they're a diversifier in their portfolio, can be helpful in some situations, not necessarily a bad asset to own, but you've got to think about how you invest in hedge funds the right way. It's not about wild west investing. It's about investing in strategies that are going to be both long and short particular asset classes and are able to produce those consistent returns over time. So in all of these asset classes, private equity, venture capital, private debt, hedge funds, what we've seen over the last couple of years is this proliferation of vehicles for everyone to get involved in the alternative investment universe. So prior to, we'll say, 2015, this was really the land of big institutional investors because most of the investment funds in these spaces wanted, $10 million commitments or $5 million commitments. There were also rules and regulations that prevented folks that didn't have, in a lot of cases, $5 million from investing in a lot of these vehicles. And so what's happened over the last 4 or 5 years is some innovation in this space. We see vehicles now that are open to the public in general. The minimums have come down a lot. And so there are lots more opportunities for everyone to participate in alternative markets if they want to do that. And why has that happened? Well, generally speaking, you see on the left-hand side, it's not because the big institutional private fund investors got religion and decided they wanted to help the public more. You see private equity fundraising on the left-hand side of this page. This is a chart from McKinsey. It's gone down, over the last several years pretty substantially, right? So the fund managers in the alternatives world are looking for assets because they're not getting it from their big institutional clients the way that they got it, say from 2011 all the way through the early 2020s. So they have invented things like interval funds, which we'll talk about more in a second, to try to raise money from folks that don't meet those historical qualified purchaser or accredited investor standards. And so Let's talk about that a little bit. What is an interval fund? These are the vehicles that you see, BREIT or BCRED, you see most commonly associated with, the opening of alternative private markets to other investors. So interval funds, they are funds that invest in private assets, but also attempt to provide liquidity generally on a quarterly kind of basis. And so what that means is that up to 5% usually of the fund can be redeemed each quarter. They have what's called 1099 reporting for taxes, which is great. Private funds, historically, by the way, produce these things called K1s, which means that you can't, if you're invested in a private fund, you generally can't file your taxes until you have to file an extension in the spring, and then you can finally file your final taxes in October. So if you're not used to filing taxes on extension and you start investing in private funds, you're going to have to file your taxes later in the year. But interval funds solve this. They generate 1099s in January, like all of your other investment accounts. So they have a 1099 reporting structure, so that's good. They're registered with the SEC, right? So they have to go through some diligence from the government, from accounting firms, et cetera. And so, that's what helps remove those requirements that the investors be sort of qualified or accredited institutions that lets folks at large invest in these vehicles. The thing that's really, really important for folks to understand is that the quarterly liquidity that's in some of these funds can be a little bit of a myth, because no one wants liquidity when everything is going great, and everyone wants liquidity when things are going bad. And so if only 5% of the fund can be redeemed and everyone wants their money back, is everyone going to get their money back? The answer to that obviously is no, right? And so what happens is when we go through cycles in down markets in any of these asset classes, generally speaking, you're not going to be able to get your money back out of these funds when you think that you want it back. And so it's really important that even though there is some liquidity, I tell folks generally when we're talking about private investment vehicles, even if there are some liquidity options, to think of it as a fund that we're going to invest in for 5 to 7 years, just like we would any other kind of private investment, because the idea that we're going to be able to get out of it if we need to get out of it is the chances of that are pretty remote from happening. You can see a couple of examples there on the chart of redemption limits and things like that were put up in the last few years. The other thing that is really important in sort of this new world of interval funds is whether or not what you're buying is really the asset class that you think you're buying into. So a lot of the big private equity sponsors, right, we just talked about a second ago on the last page, they're having trouble raising capital. And so what they've been doing is creating these interval funds, and those interval funds generally invest in things that are called secondaries. And what a secondary investment is essentially an investment that has already been owned by a private equity fund. So the company was purchased maybe 10 years ago by a private equity sponsor. They've owned it for the last decade, but now the people that are in that particular private equity fund want to get out of it. So either the current private equity fund sells that business to a secondary private equity fund, a new fund, or the LPs or the owners of those private equity funds sell their shares in that fund to these new secondary funds. So what you're getting in a secondary fund is not the same thing as traditional private equity investing, where you raise capital and then the private equity sponsor goes and finds a business that's undervalued and then they try to grow it over time. You're buying a business where that process has already occurred. Does that mean this secondary investing is bad? No, it doesn't. A lot of times the secondary market is created because either the private equity fund manager or those private equity investors need liquidity. They want to be able to sell the assets. Maybe they're not able to do that. And so a lot of times you can buy the holdings at a discount to where that company would maybe trade, on the market at large. And so there can be return opportunity in the space. But what's really important to note is the return opportunities in the secondary private equity market in these interval funds are not the same as the primary private equity market, because they're different assets. They're going to produce different kinds of return profiles, because what you're getting is something that is different. So a lot of times I talk with folks and they say, oh yeah, I've got this private equity fund, right, that's in my portfolio. And really what they have is a secondary fund. And then the performance is maybe good, right? It's positive, but maybe it doesn't have quite the same level of performance that they were expecting based on what historical private equity returns have been. And the reason is because they don't actually own a true private equity fund. What they own is a secondary fund. So it's important when you start looking at these public market vehicles that have been created, whether it's private debt, private equity, any of the different funds, it's really important to understand what you're actually buying and whether you're actually buying an alternative that is the asset class that you think you're buying, or whether you're buying some sort of creation that has happened in the marketplace after the primary sort of alternative investment sort of decision and returns have been realized. So just pay really close attention to what you're buying in these interval funds if you choose to use them. And then lastly, The last topic for today, where should I hold my alternative investments? There's been a lot in the news over the last couple of years about, maybe having alternatives inside of 401ks. Donald Trump thinks we should be able to do that, right? So what's the sort of the current landscape of this? So currently there's an executive order that Trump has signed, right, that's directing the Department of Labor to review the rules around what can go into your 401k and what can't go into your 401k. So it's likely going to be next year or even longer before there's any really movement on what those rules are. So right now, you still can't hold alternatives in your 401k. That could change. The guidance, though, that we've seen requires a couple of things. So one, it requires a fund-to-fund structure. So that means instead of you investing in a private equity fund or in a private debt fund, you're going to have to buy a fund that then goes and buys several different private equity funds or private debt funds. And there has to be enough liquidity in there to cover anticipated withdrawals. And so that means they're going to have to hold some cash in that fund. So both of those things, that having an extra manager on top drives up costs, right? And so you'll have a higher level of expenses than you would if you invested directly in the private equity or private debt. And there's this cash drag that comes from having to hold cash to cover redemptions. Both of those are going to drag down performance in institutional markets. And so if you remember, when we talked about the performance of private equity and private debt, they do generally outperform some of their public market peers, but the outperformance is not really, that strong, right? We're talking about, a few percentage points, somewhere between 2 and 5%. Well, if we start putting fund-to-fund structures on top of that, increasing the fees, having to hold liquidity, the drag from those new things inside your 401k may mean that really you're not getting any returns that are different than if you had just invested in fully liquid, publicly traded stocks or bonds. So just be thoughtful about, whether what you're going to get again in your 401k is going to, be the same thing as what maybe an institution is getting when they're investing in private equity or private debt. Where should you hold them, right? So on the right-hand side, you see the smile. This is a good chart to just think about, where should I put various asset classes? We do this when we allocate assets for clients all the time between the different investment accounts that they have. Generally speaking, private equity, the assets that produce a lot of growth, we want to put those, as much of those things, in a Roth or in a 401k as we can, right? And then once we're done filling up those buckets, and we'll put some in brokerage accounts as well, because brokerage accounts have those, you pay capital gains taxes on them, but you don't have to pay income taxes on them. So if we could put private equity in a Roth and then the rest in a brokerage account, that's probably a pretty good setup for a private equity investment. And then you see things like hedge funds, private debt, commodities, real estate, et cetera. Those things would lean a little bit more towards either IRAs or 401ks because they're paying off high levels of income, generally speaking, or they have a lot of trading activity that's happening underneath them. And so, for those types of investments, we also like to tax shelter those things as well. So maybe those have a place either in an IRA or in a 401k versus in a traditional brokerage account. And then you get things like commodities and precious metals are more sort of in the middle ground. You can just put them wherever you have space left over. So would we like to put alternatives in 401ks and IRAs from a tax perspective? Absolutely. There's definitely some benefits to doing that. But the challenge, again, as we said, is whether or not it's sort of worth investing in them at all, because the returns that we get once they're sort of watered down and filtered through all of the guidelines that are required to put them in there, they may not be what we think they're going to be. So in conclusion, when we think about alternative investing, a couple of things to think about as we wrap up. One, I like to take all of the alternative universe and just simply group that back into groups of assets that either provide growth or provide diversification. That's really the right way to think about them. Think about them as alternative or not alternative. Second, you're going to hear a lot about how the alternatives provide a lot of diversification to your portfolio. They have low correlation. That means you should buy them. Well, we talked about that in detail, and what we should remember from that conversation is that just because they show low correlation and statistically they look good, those statistics may not be real life because of some of the reporting differences between public and private markets. And so let's just assume that if we're buying an equity investment or we're investing in private equity, that the risk of that is the same as public equity, and the same thing with debt. If we're investing in public debt, private debt, those really have the same sort of levels of risk and return there. So let's not get caught up in sort of the statistical sales pitch for alternatives. That doesn't mean, however, that they can't be beneficial for your portfolio. Private debt, private equity, those kinds of things can produce returns that are above their public market peers. So there could be a place for them in your portfolio, but it's probably on the return side of the spectrum, not purely as a diversifier. And then lastly, manager selection really matters, right? So it's it's not, you can definitely make bad investment decisions buying mutual funds, but the likelihood that you're going to really make a mistake buying a mutual fund is a lot less than it is in the private alternative investment space. The return dispersion is a lot larger in the alternative space. You can have some funds that make money, some funds that lose money. So making sure that you can do diligence, right? Making sure that you understand exactly what the strategy of the manager is that you're investing with, making sure that they're doing all the things that they're supposed to be doing correctly. There's a lot more fraud in private markets than there is in public markets. So there's just a lot of things to watch out for. So it's very, very important that you do your diligence, that you're thoughtful about how you invest in alternatives. So hopefully this episode was helpful. Again, it's a little bit of a presentation I stole from some work that I did earlier this year with a group of investors. So I hope you find it helpful as you think about alternatives, whether you should have them in your portfolio or not. Hopefully this answers some of the big questions that are on your mind. And as always, if you have questions, I'm happy to talk about those anytime, alternative investments or otherwise. And we will see you on the next episode of the Capital Stewards Podcast.